Welcome to One for the Money, the weekly talk show with interviews you can use. I'm national financial columnist and talk show host, Steve Savant. And on today's show, protecting your property. Most people have homeowners and car insurance because in most states it's required by law. But are you aware that you could secure the coverage you need and save real money at the same time? Money you could put aside for your retirement. And to help us understand how to make smart money decisions by buying coverage for our homes, cars, personal property, recreational vehicles, this week's special guest, property casualty specialist Jay LaSalle with
Allstate.
All here on One for the Money. Well, welcome to the show, Jay.
Good to be here, Steve. Thank you for having me.
I'm glad to have you here, and because what we're always doing, our show is all about saving money in different areas. We've done debt reduction, we've talked about Social Security, we even had Dr. Jack in last week talking about the psychology of money, which really I felt like I was on his couch trying to go through my own personal pathologies. But I want to talk to you today because you've been in the property casualty business for a long time. And I am amazed, and I mean amazed and shocked, that most consumers will not take their agents up on doing a policy review. Now, when I was doing a pre-interview with you, you said that 90% of the policy reviews that you go through could save people money. Why would you not go and get this done?
That's a great question. I ask myself and my staff all the time how difficult it is sometimes to get the clients to do the policy reviews. So we've started doing them over the phone because a lot of our clients prefer the phone rather than taking the time to come into the office. And either way, whether it's phone or in person, like I said, at least 90% of them end up saving money. I don't know why more of them don't do it. We email them, we call them, we offer the policy reviews. Once they do take us up on them, they save money. We find discounts, we look at coverages, make changes that are necessary for them, and I've never had somebody leave a policy review unhappy.
Well, what I like about policy reviews is it talks the very thing you said. Well, there could be coverage issues. Let's figure out what that number is. There could be deductible issues. There could be that could be a number. And here we are, a whole other set, discounts. Those three areas could be significant money. And that's why we're always trying to find out, I don't know about you, but I don't like to spend money on insurance. I don't. And I don't think any consumer does. But remember, state laws, like in Arizona, we have to have coverage for our cars. If we're running our car payments through a bank or an institution, we have to have coverage for that. We have to have coverage for our homes. We have mortgages. They're mandated. So when I'm looking through all this, I'm thinking, well, I have to have the coverage, but why should I pay any more money than I have to do? So I just want to talk about a few things. Let's talk about car insurance. Now, the reason I think about car insurance is like, I remember back in the day, it was a major issue for a family to have one car. Now you have two cars with two earners. But now children have their own cars. And I mean, I have my last child on our policy. And those numbers are shock and awe, right? I mean, those numbers are big.
Yes.
So I want to walk through a little bit about what am I looking for on auto to try to really get I still want coverage. I don't want to be chintzy on it, but I want to be able to get my coverage and save some money because I want to take all the savings we do on our show, no matter what the topic is, and set it aside for retirement. So what do you look for in auto? What am I looking for?
Many aspects. First thing is you look at the operators. So you look at the different drivers that are on the policy, and then you look at the coverage limits. And so first you got to ask the client, what limits are you comfortable with? And a lot of it goes back to what level of protection do they feel like they need to protect their assets. So that's where you're determining your liability insurance. Then you look at, and I believe in the benefit cost analysis. So you've got to look at, this is the cost of the premium, this is the benefit of the coverage that I'm getting.
Is it worth it?
Absolutely. And so deductibles is a place where a lot of people can save money. I'll look at collision deductibles and comprehensive deductibles, which those deductibles pertain to the insured's vehicles, not other people's vehicles, the insured's vehicles. And sometimes with a little bit higher deductible, they can save a little more premium.
If our consumers that are watching this show right now have good motor vehicle reports, and they have a consistency of always really driving well, and now they have these new things these new mileage that you can get some discount. And does it track your speed?
It does track your speed only to the point of they're not GPSs, so they don't know where you are or what the speed limit is where you are, but they track if you go over 80 miles per hour. And that's a negative hit if you go over 80 miles per hour.
If my son is watching this show right now, just remember, we're on that plan, so better keep it under 80.
Absolutely.
So if I have a good record, I'm wondering, people are tentative sometimes about raising their deductibles because it's going to save them money. And so if they have a really good record, and they have, what would be the reason you could say you might want to consider it only because you are a very conservative driver, you have a long-standing car that you have, it's not like it's a brand new car, you're not financing it, you have it paid off. Are there reasons for going to up their deductible to help them save money?
What I like to look at for clients is I tell them, this is your current deductible, let's say it's $500 on collision, and if we bump that deductible up, whether it's to $600 or up to $750 or $1,000, this is the savings associated with that change. And so I just lay it out for them saying, okay, let's find the break-even point. Well, the break-even point may be 2.5 years. You've already saved enough money that in premium that you just risked on increasing your deductible. And that helps clients look at it, and then if they want to say, well, what do you think would be the right call? I would always say, well, look at your history. Your history shows that you haven't had a claim for over 4 or 5 years. That's way beyond your break-even point. Sounds like a good move to change it.
Well, that's what I'm always looking for. I need to know what my necessary coverage is, which is what we're going to talk about in the second segment on 2 for the Show, because necessary coverage, I want to know what I need, what's good for my protection. I have to protect my assets against liabilities and people who would want to come. We're in a litigatory society, so I want to make sure I'm doing all my protection and pay the right premium. When we come back, we're going to talk about some of the necessary coverages for home recreational vehicles. We'll just try to throw it all in there and save you some money for retirement.
Did you know the average 401k runs out of money just 7 to 8 years into retirement? Time Magazine, the Wall Street Journal, and many other publications have warned of the difficulty of saving with a 401k. But what if there was a way to create tax-free lifetime retirement income with no stock market risk? Good news, there is.
You know, living in fear of the next market dive is not the way I want to live my life.
Why would I go out there and take on risk when I don't need to?
I have a lot less stress knowing I can't lose any more of my retirement savings in the stock market.
Call now to receive your free, no-obligation analysis of what this retirement vehicle could do for you, a comparison to your current retirement plan, and a free video that explains this exciting opportunity. Start planning a retirement you can enjoy instead of worrying about future tax increases and stock market losses. Creating income that will last your entire life is the most important thing you'll ever do. Take control of your future. Call now for your free analysis, comparison, and video.
Well, welcome back to our 1 for the Money Show. We're in our second segment, 2 for the Show, where we like to educate consumers. And we're talking about necessary coverage. And one of the things I always like to look at is, how am I going to educate myself so I can make a right decision? And sometimes you have to transfer some of your lack of knowledge to your agent. You have to depend on them, trust them, to be able to walk with you and partner with you in pricing this out. Now, when we're talking about car insurance, a lot of people say, Steve, well, isn't it true I only have to cover the other guy, his problem? I don't have to cover my own vehicle. Well, I guess if you didn't have a lien on your car and it was free and clear, you could do what you want. Do people really save that much more by taking off the coverage for their own vehicle? Is it a lot, or it depends upon the age of the car?
Depends upon the age of the car, and it also depends on the age of the driver. Younger operators, as you mentioned, with your youngest being on your policy, younger drivers are more expensive operators. So there's a lot of factors that depend on the cost of the savings for the collision and the comprehensive deductible. But we have that conversation with clients all the time during the reviews as they look at it. Obviously, if there's a lien holder, they're required to have collision and comprehensive coverage. And if there's not a lien holder, it's completely up to the individual if they want to have it.
There's some math to it. I've seen, like, for example, my son has an older car. This year, when I went to review it, I said I'm still going to keep the coverage on it, but maybe 6 months from now, as the value is depreciating, I'm going to think maybe I'm not going to cover that part of the aspect and bring that premium down. There's so many areas, deductibles, discounts, and good driving records, all these things compound, the age of the operator, all these things, you could be saving yourself significant dollars. Now I want to shift a little bit, because one of those discounts is, well, if I have a car, do I have a home? And can I double up on my discounts by putting both on the same policy, which I do, and I recommend it to everyone. When we get into a home, talk first about deductibles, because we always talk about $250, $500, $1,000 deductible. I'm really looking for wind damage issues in Arizona. I mean, we're using our state as an example. And remember the poor people in the East Coast. I mean, flood insurance. I hope people had flood insurance as an extra rider to their policy. But when we're talking about it, what about deductibles for homeowners? $250, $500, $750, $1,000. Is that something to look at, or is it really not that much of a value of savings?
The deductible's a big savings, especially on homeowners. Depending on the value of the home and the level of coverage, a higher deductible could save you a significant amount of money. And there's a number of clients that the $250 and $500 deductible day is a little bit past. There's not as many people that hold those level of deductibles on property insurance. Usually I see $1,000 is very common. Some people, even on higher value homes, I'll see them go with even higher level deductibles.
What is that higher number? What's the highest deductible generally on an opulent home?
$5,000.
So yeah, the first $5,000 would be their problem.
Absolutely. So a lot of people look at their home insurance as catastrophic insurance. So if something major happens, then they're going to file a claim. Other than that,
you just brought up something. Talk about major catastrophic. What about the economy? I mean, in 2004 to 2008, our home values were going up. Agents were calling their homeowners saying, listen, you need to keep pace with the value of your home. The replacement value is nowhere near that, so everybody started buying extra insurance coverage because of the appreciation of their homes. Well, then 2008 hit, and it went down the tank, and it's so surprising for me to say to you that I see so many consumers still holding to those original numbers that they bumped their house up to in 2008 when that value is lower. Should they readjust that?
Absolutely, they should. And that's one of the best things about the policy review is I tell clients, you have coverage limits. Well, the insurance company, that's a maximum that they're going to pay. If it costs less to rebuild your structure, that's what they're going to pay, whatever it costs to rebuild, up to your coverage limit. So I tell people if you can decrease that coverage, you can save a lot of money. And we save people hundreds and hundreds of dollars every year on their property policies by doing those reviews and seeing what is realistically the cost to rebuild your structure in today's value.
So if I look at that and I say, wow, the number I had on there from 2008 is kind of high. I could actually save money by having it reevaluated, assess it for what it is today, and get in the game on that price tag. So when I'm talking about discounts, deductibles, looking at my appreciation and seeing if I can match the value, we just named two things, an auto insurance in the same area as well as the homeowners, where this is significant. There's some money we're talking about here. And everybody's so concerned about retirement, which I am as well. I think we're under-retired. Our accounts are just not going to make it. We're all going to be living longer. So when I'm looking at property casualty, this is a great place to go. So in a policy review, we're going to talk about the value of the home. We're going to talk about the deductible. And what else should I think about on that? Just on that part of the home, a home audit.
What we also will talk about is a lot of people don't realize that most companies, when they have your dwelling protection, most companies add a little bit of a buffer for replacement cost. And so people see their dwelling coverage, say, at $500,000, and they don't realize that there could be a 20% or more buffer. So really that $500,000 is $600,000 that the insurance company is going to pay. So it gives you more leeway to potentially decrease the coverage and save some premium.
Well, if you're a homeowner or an auto owner and you want to get a discount to have them both on there, most carriers do this. It's an excellent way to play, saving money and discounting. And when we come back, we're going to talk about preparing for an audit. We're going to go through the gauntlet of a few other things we're going to add on to it, one of my favorite recreational vehicles, and just really talk about how to prepare for an audit so we can actually save money for the coverage that we need.
Did you know the average 401k runs out of money just 7 to 8 years into retirement? Time Magazine, the Wall Street Journal, and many other publications have warned of the difficulty of saving with a 401k. But what if there was a way to create tax-free lifetime retirement income with no stock market risk? Good news, there is.
You know, living in fear of the next market dive is not the way I want to live my life.
Why would I go out there and take on risk when I don't need to?
I have a lot less stress knowing I can't lose any more of my retirement savings in the stock market.
Call now to receive your free, no-obligation analysis of what this retirement vehicle could do for you, a comparison to your current retirement plan, and a free video that explains this exciting opportunity. Start planning a retirement you can enjoy instead of worrying about future tax increases and stock market losses. houses. Creating income that will last your entire life is the most important thing you'll ever do. Take control of your future. Call now for your free analysis, comparison, and video.
Well, welcome back to our 3 to Get Ready segment, and I want to talk about, well, we do want to talk about the reviews and preparing for it, but before we do, I want to talk about umbrella policies for a moment.
Okay.
Because, Jay, I'm surprised, especially when you look at higher-end clients who have, maybe they have a nice home, they have nice cars, but they have a lot in their retirement account. They got great cash positions. They have other investments. And they're just protecting their car, their home. But sometimes I think they need to throw another extra layer on for an umbrella policy. And I noticed that out in the market, pretty much you have about $1 million to up to $5 million of coverage you can put on that. I was surprised when I bought my first pup policy because I had teenage drivers, which was one of my biggest reasons. I wanted to put an extra layer so they can come after my other assets. Jay, it was $250 for $1 million worth of coverage for the whole year. Why would anybody not have that basic coverage? See, I was surprised at that, to be honest with you.
There's a lot of people that don't have umbrellas, and we bring it up to clients about the potential need for umbrellas. But the way an umbrella policy works, and when you say PUP, that's personal umbrella policy. And they usually start at $1 million, and like you said, personal ones usually go up to $5 million if needed. But I tell the clients, it depends on your assets. If you have assets to protect, then you should have the liability coverage to match the assets that you need to protect. Because if an unfortunate accident does occur and you injure somebody else, most likely they are going to hire an attorney, and they're going to at least find out, they're going to do their due diligence to find out if you have assets for them to come after. And if you do, they're going to come after those assets. So it's better to have the insurance company protect it.
Well, I think, again, just as a regular consultant, I think if you have teenage kids driving in your car, that alone should make you make the move, right? So, and when we're talking about umbrella, we're just adding a little bit of layered defense, and look at the amount of money it costs. I mean, and for my teenage son, for me to put it on for protection, it's $250 a year just to have that extra layer.
It's a great deal. Adds $1 million of coverage to all your liability policies, whether it's not just auto, it can be home, I mean, whatever policies you have.
Well, let's just add another one. My fave, recreational vehicles. Okay. I mean, we talking RVs, we're talking Land Rovers, you're talking your little golf cart that people drive around in the neighborhoods. Talk a little bit about that, because I think sometimes we forget about that. Motorcycles, right?
Motorcycles, boats, water skis, wave runners, jet skis, all of those need to be on a separate policy. A lot of people think, well, I have it in my garage, it's stored. Well, if something happens to my home and damages those, then they're covered. Not the case. That's not covered.
Wow.
Because if it has an engine, rule of thumb is if it has its own engine and you can ride it, then it needs its own insurance. And so there's jet ski policies, wave runner policies, boat policies, ATVs, golf carts, like you mentioned, all of those.
Well, let's say just take one for like a jet ski.
Okay.
What kind of money are we talking about to protect that asset?
You're usually talking about, could be about $150, $200 a year.
So you have to weigh it out. Hey, is this a fairly new machine? Do I use it that much? And then make a decision. In fact, actually, I always say, as I've gotten older, I noticed that recreational vehicles now are not in my house anymore, so I'm starting to get rid of things that I'm not going to use. That could be a good place. When we're talking about different aspects of additional policies, I noticed that on one of our clients, we did a review, and part of their review, I noticed they had an addendum onto their homeowner's policy for their separate jewelry. Talk a little bit about that, because we're talking about recreational vehicles, that's a separate policy. They had an actual separate addendum to that, because I thought, well, aren't all your personal property covered? They said, oh no, we have to have a specific one for jewelry. And so I'm thinking, a lot of people have jewelry that are very expensive, and they need to photograph it, catalog it, and put a policy on it.
Yeah, absolutely. The homeowners policies often have maximum coverage for items like theft. And so jewelry is one of the most commonly stolen items. And so when you reach that maximum, which is usually very low maximums on your regular home policy, you do what's called a scheduled personal property. We call it SPP. And that not only gives you as much coverage as you want to pay for the scheduled personal property, but it also gives you more perils. And when I say more perils, it means more types of coverage. A good example is if somebody, engagement rings are things that are very commonly scheduled on people's homeowners policies. So an engagement ring, often if there's a diamond, if a diamond were to fall out, that's called mysterious disappearance. That would only be covered under a scheduled personal property policy, not under your regular home policy.
So if you don't have that secondary policy, you don't have coverage.
Absolutely, that's correct, you don't.
And I've heard that that little episode of the stone falling out of the ring is quite common.
More common than I ever thought it would be.
I think that's intentional by the jurist. He's just leaving it so he has more business. Well, when I'm thinking about coverage, when I think about condominiums, renters insurance for apartments, different other dwellings, in-state, out-of-state. When I come back in the next segment, I want to ask you about those kind of properties, because I think we kind of forget. Oh, I have a cabin up at Lake Havasu. I have a condo where I ski up in Denver. You know, we kind of forget. Are we renting it? Are we owning it? Are there different price tags, different ways of looking at it? Because when we come back, I want to not only prepare for some of those ancillary dwellings, but I want to be able to figure out holistically, can I combine all this and get some kind of discount so that I can pay less for the coverage I really need? We'll be right back after the break.
Did you know the average 401k runs out of money just 7 to 8 years into retirement? Time Magazine, the Wall Street Journal, and many other publications have warned of the difficulty of saving with a 401k. But what if there was a way to create tax-free lifetime retirement income with no stock market risk? Good news, there is.
You know, living in fear of the next market dive is not the way I want to live my life.
Why would I go out there and take on risk when I don't need to?
I have a lot less stress knowing I can't lose any more of my retirement savings in the stock market.
Call now to receive your free, no-obligation analysis of what this retirement vehicle could do for you, a comparison to your current retirement plan, and a free video that explains this exciting opportunity. Start planning a retirement you can enjoy instead of worrying about future tax increases and stock market losses. Creating income that will last your entire life is the most important thing you'll ever do. Take control of your future. Call now for your free analysis, comparison, and video.
Well, welcome back, everyone. We're in our 4 to Go segment. And when we talk about getting ready to do something about it, because we're always into next steps in the 4th segment. But before I do that, I want to talk a little bit about, and of course, I want to talk my condo, I want to talk my cabin, my renter's insurance, if I have that issue. But when I mentioned earlier about relationship with an agent, people say, Steve, I appreciate everything you're talking about, but I can't keep all this straight. I don't know how I can make an actual economic decision if I don't know everything, and do I have to know everything? And part of that is vetting a really good agent, making sure that you've chosen a relationship that you have trust. Talk a little bit about that, because that's big.
I think it's critical. I look at anytime I have a need for a professional, I hire the professional. If something's wrong with my sink, I hire a plumber. If I need an auto mechanic, I go to an auto mechanic. I don't try to do this stuff myself. And so use your insurance professional for what they're there for. It's their job to know how to best protect you. And it's also their job to find as many discounts as possible to save you money while protecting you. And so I think building a relationship, you mentioned it earlier in our segment about trust, that you need to trust your insurance agent. I think that's imperative. And I love it when I have a relationship with a client where they know I'm looking out for their best interest. And that's when you know your insurance provider is going to take good care of you. And so, but you need to open up to them. You need to have an open dialogue. You need to let them know what's important to you. You need to let them know what items you really need protected. And then let them tell you, one, the cost for it, but then also let them tell you the best and most economical way to take care of your needs.
Now we've talked about a lot of discounts over the last 3 segments. Some of the discounts are actually monetary in nature. Like, for example, it's interesting that people could save up to 11, maybe sometimes depending upon the carrier, 11 to 15% if you just paid the 6-month cost for, like, your auto as an example.
Yes.
That's 11%. People say, how can I get more savings? Well, I just gave you one. Or can you bill directly? Isn't there a discount for that too now?
You can bill directly to a checking account.
Okay, that's one.
We call it through Easy Pay. You can pay every 6 months. That's called a pay in full discount. You can also have a discount for having the bill emailed to you instead of mailed to you. It saves the cost of shipping for the company. There are age and retired discounts that a lot of clients aren't aware of. So what we try to do is Number one, a lot of people don't read their policy information, and when they get their renewal package, it's foreign to them, and they just go right to the price.
Well, wait a minute, just on that issue, yes, it's foreign. Everybody, I've been in the financial services for 30 years, but the moment I walk into your world, I'm reading this property casualty document, and I'm lost. And even though it does do a decent summary and really walks me through it, it's difficult. That's why I keep pressing everyone. A policy review can save, I believe, major money. Think of all the things we've talked about in these 4 segments. It can save you significant money. So when I'm talking about these are economical issues. Hey, am I going to bill direct? Go ahead with my email. They'll bill me by my email. I'll pay. It'll come auto out of my checking account. All those things are going to save up to 11% of my premium. Why would I not do that?
People need to take advantage of the discounts. Pay the least amount of money that you need to pay for the coverage that you want.
When I talk about my favorite things like, oh, I have a rental cab, I rent a cabin, right? I am the renter, or I'm renting it out.
Okay, landlord.
Talk about it. Yeah, I'm a landlord. Okay. No, I'm a renter. So talk about both those sides of the fence.
If you own a property and you don't live there and you rent it out to somebody else, that's called a landlord property. And so it's very similar to a homeowner's policy. It just has very small amounts of personal property coverage. Now, if you furnish the property, you could still get additional personal property coverage.
What's the difference? How much does it take off if you're really a landlord in a home, but you're not furnishing the home at all?
Oh, it'll take off hundreds of dollars off the annual
So it's
premium.
significant.
Yeah.
So you have to figure out, if you're a landlord, should I furnish it or not, just based on how much money do I have to shell out every year for that?
You'll definitely save money as a landlord. And like you talked about earlier about bundling, is if you have multiple policies with the same carrier, then all of the different policies get discounts. I know with Allstate, like on the landlord policy, they give 35% discount just on the landlord policy if you also have the home and auto.
So these are really things to look at. What if I'm a renter though? You know, I'm in an apartment, or I'm a young person. I haven't bought my first home yet. Sure. But I have things I want to cover, and I want to have renter's insurance. I think it's so inexpensive. I can't believe it. I mean, the last one I saw was under $200.
Oh yeah, renter's insurance are very inexpensive, and not only does it cover your personal property, but a lot of landlords, especially apartment complexes these days, are requiring you to have liability insurance. And with a renter's policy, the minimum liability protection you get is $1 million. And that is $100,000, excuse me.
Policy I ever saw.
Then you don't need the umbrella. Right. No, it's $100,000, and that's usually what's required by these apartment complexes. They don't care about your personal property being protected, they care about their liability being protected. But renter's policy is very inexpensive, and often the multi-policy discount that you get on your auto policy for having a renter's policy or any property policy outweighs the cost of even that additional property policy.
Well, that's why I like bundling. I love the whole package deal of discounts, deductibles, looking at all my assets and seeing what's the best way to cover it. I think it's significant to do a policy review. It's a must in my book, especially if you want to pull maybe $1,000 to $2,000 out of this contract on everything that you're into to put money aside for your retirement. People are always saying, Steve, I'd put more money away if I could find the money. We've just shown you today's show at Property Casualty, how to save money. Remember, we have the strategies to help you with your money-saving experience, and we've partnered with financial professionals who know the value of money and its impact on your retirement. For more information on how a policy review can save you money, more money for retirement, just go out to the show's website at www.oneforthemoney.tv. And remember, you can follow me on Twitter and visit me on all my social media network sites: Facebook, LinkedIn, YouTube, Google+. That's One for the